Welcome to The Marcus Warren Show, powered by 960 Digital and the Wealth Empowerment Network. Now, here is your host, Marcus Warren.
Here we go on a Wednesday. It's The Marcus Warren Show, the #1 retirement and tax planning show in the region. I am your host, financial advisor, tax enrolled agent, and author of the Retirement and Tax Playbooks, Marcus Warren. And I hope everyone is doing well on this Wednesday. And to my left, I am joined by our resident tax professional, Dee. How you doing, Dee?
Hello, and happy Wednesday.
And remember, if you missed any parts of the show and you want to catch up on anything that you missed, all you have to do is subscribe to the Marcus Warren Show podcast via Apple Podcasts, Spotify, or wherever you get your podcast. Also, throughout the show, we will be offering our Retirement Rescue Game Plan, which is a physical packet of information that will help rescue your retirement from all the risks that threaten your nest egg once you are close and in retirement. Now, in that game plan, you'll get a copy of my 2 books, a few different financial reports, and access to my webinar entitled Taxes in Retirement. Now, you may be asking yourself, how can I get my hands on that awesome material, Marcus? Well, you can simply order that by going to warrenwealth.net. That is warrenwealth.net. Go to the site, put in your information, and that Retirement Rescue Game Plan will be delivered free of charge to your front door via USPS. Once again, all you have to do is go to warrenwealth.net. So I want to start with this. Let's go ahead and jump into Money Matters.
Here comes the money.
Here we go. Money talk.
Here comes the money. Money, 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 money.
All right, so I want to start with this. So today is Wednesday,
Yes.
the 15th.
That's right.
And I want to take everyone back in time. To just last week. Okay. Because a lot has gone on, and specifically in the banking industry. And I'm sure the listeners, or may not know, but there's been a lot going on in the banking industry. So last Wednesday, March 8th, Silicon Valley Bank, the 16th largest bank in the U.S., they said that they needed to raise funds, and they liquidated $21 billion worth of investments, right? The next day, Thursday, March 9th, customers got wind of this and they panicked, and they went to the bank and they attempted to withdraw, all their customers attempted to withdraw $42 billion worth of their funds. So by the end of Thursday, March 9th, Silicon Valley Bank, they had a negative cash balance of $1 billion, and the stock was down 60%. Then on Friday, March 10th, trading on the stock was halted when the stock fell another 60%. And then the FDIC shut them down. So if you've been listening to the news, you've been listening to the pundits, so forth or so on, most people know this. And so the question becomes, what led to the demise of this bank? And what triggered this, I'm going to call it a mini banking crisis that's sweeping the U.S. A matter of fact, my mom sent me a text yesterday that basically said, should I be worried about the banking industry? And I'm like, no, Mom, not at all. All right. So there always has to be someone to blame, right? Everyone looks for a scapegoat. Everyone looks to blame something when something happens. So I guess you could blame the bank's executives who bet a good portion of their assets, $80 billion on these long-term bonds and T-bills that just basically died when interest rates started to go up, basically eviscerating their funds and their investments, right? If you want to go back, which a lot of people do, you could blame the Federal Reserve, right? Because when inflation shot up, they were so late to act, and then they overreacted by quickly raising interest rates, right? Just killing investors and their bond portfolios, right? Think about this. Interest rates went from 25 basis points all the way up to 475 basis points in 12 months. We hadn't seen anything like that since 1979. And so that is why those of you who are out there who had those 60-40 portfolios, and when the stock market went down last year, and then your bond portfolios went down last year, and everything was down last year, you were thinking, wait a minute, I thought when stocks crash, bonds are a safe haven, not when interest rates are going up. And the Fed, maybe they waited too long and then overreacted and raised them too quickly, but I'm not here to judge that. But you can also blame, how about we blame the interest of the likes of Trump, Senate Republicans, the techies in Silicon Valley, bankers, even some Democrats who back in 2018 rolled back regulations for mid-sized banks, basically setting the stage for things like this to happen. And then, of course, you could just blame the VCs. What are VCs? Venture capitalists, right? Who basically 1 week ago, Silicon Valley Bank, they were technically insolvent if you look at their balance sheets, but they were far from being out of business. Without this massive run on the bank on its deposits, the bank would have likely kind of puttered along without having to liquidate those long-term bonds. Right now, they put themselves in a bad position because duration risk was a huge risk that they took on. I'm not going to get into that, but they probably would have been okay if not for the venture capitalist who, with the assistance of what I call the devil incarnate, social media. And so what happened? Well, Silicon Valley's bank, their leadership, they tried to raise those funds, right? They tried to get $21 billion. But a large venture capitalist fund, Founders Fund, they and other VCs, they got wind of this. And they said, let me get my money out. And they started to pull their money out. And when other startups heard about this through group chats, Twitter, all the social media things that are out there, right? They all raced for the exits. And like I said, last Thursday, not even a week ago, those customers withdrew $42 billion. Or let me put it this way, $1 million a second for 10 straight hours, resulting in the largest bank run in history. That, my friends, is what basically happened. And so, when you think about it, people think, hey, is this anything like FTX or fraud or anything like that? And the answer is no. It's just mismanagement of funds. SVB was heavily invested in the bond market. And what I've always told people about bonds, and it's funny because last year, when bonds and bond funds were going down and the stock market was going down also, I would talk to a lot of my clients and I would say, because they were asking, wait a minute, how is my whole portfolio down? I know stocks are down, but shouldn't bonds kind of buoy things up and keep things balanced at least? And I was like, well, that's the way it generally happens. But we found ourselves in this weird environment where the stock market, at least at the top of 2020, 2021, were at all-time highs. And interest rates were at all-time lows, creating a perfect storm where if the Fed started raising interest rates at the same time the market started going down, then that could spell disaster for retirees and investors. And that's exactly what happened basically last year going all the way through this year. The stock market started to go down and interest rates started to pick up because inflation was so high. And I always talk about inflation, too many dollars chasing too few products. The way that we can lower inflation, we being the American government, the Fed, is by raising interest rates. And that is exactly what happened. Interest rates started to go up. And interest rates and bonds and bond funds, they have an inverse relationship. They kind of work like a teeter-totter or a seesaw, by the way, which I have not seen at a park in years. You know, the seesaw, the teeter-totters, I don't even know.
Yeah, I remember those.
You know, I guess they're not as fun anymore because, I don't know.
Or maybe liability.
Well,
attorneys got to them.
They still have swings.
That's true.
And carousels.
That's true.
Anyway, and so it kind of works like a teeter-totter. So as interest rates go up, the value of your bonds go down. And as interest rates were going up, the value of SVB, Silicon Valley Bank's bonds, were going down at the same time that their depositors, their clients, were asking for their funds. And so they're having to sell a distressed asset or an asset that is going down in value, basically at lower prices. They became a forced seller, and you never want to be a forced seller in a down market. And that's exactly where they found themselves. And lo and behold, people are asking for their money. They don't have it because it's lent out. They have bad investments. And there you go, a classic bank run. And so let me go back real quick for a little bit and talk about when I talked about some of these rollbacks in legislation in 2018 with government, where they rolled back a lot of the mid-sized bank regulations. So generally on your balance sheets, and I don't want to get too technical, when you list your assets, you should list them at their current market value. But that's not the way that it worked out for a Silicon Valley Bank, because they didn't have to price those bonds at what they were worth at that particular time. If they were able to keep their bonds on the balance sheet as their what's called their par value, and what they basically, if they were to hold those bonds until maturity, until they came due, they would basically get that full value back. But in the meantime, the value of that bond can fluctuate. And if you were able to look on a balance sheet, you would be able to see, hey, when we first got these bonds, they were, say, at par, which is $100. But now fast forward a couple of years later, because interest rates are starting to go up, the value of our bonds are down. Now these suckers are valued at 75 cents, right? Or $75. And that would have at least thrown up some red flags where they could have gotten some reserves. They could have shored up the balance sheet somehow. But unfortunately, because of lack of regulations, and I'm not saying we need all kinds of regulations around everything, but they were able to always have their balance sheet look nice and pretty when that wasn't the case. So, ladies and gentlemen, this isn't the bank didn't fail because of any kind of fraud or anything like that, like FTX and things of that nature. It was basically mismanagement by their executives, and then the classic panic and bank run of its clients.